All right. Good morning. Good morning. How are you guys today? It's great to see you. See everybody in class first thing in the morning before the market even opens. How about that? Crazy group of people wanting to get in here and check things out on the opening bell with me. All right, guys, I have some very interesting, somewhat disturbing news. Not really disturbing, just interesting. Just interesting news. Hang on a minute. Let's get things settled here. And we're going to watch some of these markets rock and roll this morning. And I'm going to close that one. I'm going to close this one. And we're going to, boom, look at that. All the markets at once. How come we got more than we need here? Let's turn off this one. All right, we'll move that one up there. We'll move this one. Which one do we want up there? We want this one. Wait a second. We want this one up there. And there we go. That's what we want to look at. So up in the upper left-hand corner, we have the 2-minute S&P 500. Up in the upper right-hand corner, we have the Dow. That's a range bar 6 Dow. Bottom left-hand corner, we have the Russell 2000 range bar 6. In the bottom right-hand corner, we have the range bar 20. Now, I was day trading yesterday, kind of getting back to the basics. We had that little marquee icon up there yesterday that said getting back to the basics. And we talked a little bit just about the basics of the markets. And today I wanted to kind of just get back to the basics on that as well. Just kind of talk about, just do a little scalp and trail. So we'll just do a little scalp and trail. And we're going to see if the markets won't perform for us today. Now, I practiced my scalp and trail setups and strategies and everything yesterday. And I just smoked the market. Okay. Of course, in the demo account. And I was trying to set everything up, and I just made so much money. It made God's green earth turn pink and yellow and green. It's so beautiful. And I wanted to show you, but it was in the afternoon session. And the morning session is oftentimes rips our wheels off. But nonetheless, I wanted to kind of show you the strategy that I was running. It's the scalp and trail. So many of you have been here with me with this strategy, and we've run it before, right? We know the scalp and trail. Many of you know the scalp and trail strategy. So, but we got a lot of new people who haven't been a part of that and haven't seen the scalp and trail strategy. So I've set that up, and I'm going to show you what I did yesterday and how I smoked the market. All right. Did pretty well. Now, what happened is I did a lot of testing, a lot of practicing, and I would get up to $1,000, and then I would drop it back down to negative numbers. And then I'd get it make some changes and adjustments. Then I'd mark it back up. Then I'd make some changes, adjustments, and I'd lose it all back down. And then I would make some more changes, adjustment. I'd get it all the way back up over $1,000. Then I would lose it all back down. I did that for several hours yesterday. I was trying to perfect this for you as I was practicing for today's class. And so I want to show you what I did, and just really smoked the market. Just really did a good job. And let's see if we can reproduce that and show you how I did that. Now, it's kind of a fun little strategy for those of you who are not familiar with the scalp and trail. And I was doing it yesterday on the NASDAQ 100. And again, I was doing it in the afternoon session. And I was doing it on the range bar 20. Now, oftentimes we'll do the range bar 6 in the afternoon session as the market's a little bit quieter. But I was doing it on the NASDAQ Mini. Doing really quite well, so I'm going to show you what I did. Now, can I reproduce it this morning in the morning session? I don't know. We're going to give it a shot. We're going to see how well we can do. But I'm going to start off doing just the scalp to show you that strategy. And then we're going to do just the trail. And then we're going to combine them, the scalp and trail, because it gets a little complicated sometimes when you're doing, two strategies at once. Try to keep it simple, but nonetheless, it's a little bit more complicated. You have to move the mouse a little bit more quickly, and you have to be a little bit more cognizant of what you're doing. Now, the other thing about the market is I have discovered something a little bit outside the norm about the S&P 500 lately. And this is the somewhat disturbing information for those of you who are trading options. Not disturbing, just a little bit more information in the quiver for you to know and understand and realize we're going to have to make some adjustments to our wild eye, crazy eye, iron butterfly. And I'm going to tell you a little bit about that when let's do a little day trading, and then we're going to go put on our options strategy for those of you who like to do the options. But I have some new information for you I'm going to share. So wait for that, and we'll do a little day trading here. Now, the morning bell has already rung, 7:32, rung 2 minutes ago. So at 7:30 right there, that was the morning bell. And of course, we're here in the futures market, so there is not really a morning bell. It's an afternoon bell because these are 23 hours a day traded markets, right? And so that's our morning bell right there. And the market didn't really change much. It just kind of wandered, didn't it? Right through it, just like it didn't even happen. Now, when we trade the scalp and trail strategy, we have to be very cognizant of where we think the market's going. Now, it's not like we can just kind of randomly come in here and start picking a spot and jumping in and out of the market. We still want to do our due diligence, right? We want to be smart about the markets. We're going to come in here and look a little bit at the news, and we're going to see what the market's going to do today. And I'm going to refresh that, make sure we're on Impact 2. And it says 6:30 this morning we had export prices, import prices. The big news is at 8 o'clock. That's in 25 minutes, Michigan's consumer sentiment. And so the forecast is 72. The consensus is 72. The previous was 61, 69.1. So Michigan consumer sentiment, I don't know. I think up is good, right? The University of Michigan consumer sentiment was revised higher to 69.1 from a preliminary reading of 67.4, but remaining the lowest in 6 months. Inflation expectations for the year ahead increased less than initially anticipated. The preliminary but remained the highest to 6 months. University of Michigan consumer sentiment. So higher is better. So higher, good, higher. So the preliminary estimates remain the highest in 6 months. Also, the 5-year inflation looks steady at 3. Am I reading that right? Meanwhile, both current conditions, 69 expeditions were revised. Outlook business. Well, the market's going to move. All right. And that's really all we need to know. Whether it goes up or down is not for us to determine anyway. I always say that. Don't look at this and say, well, the market's going to go up if we get good news, because it oftentimes doesn't. Oftentimes you get what seems to be good news on these reports and the market flushes because it wasn't up good enough, or something like that. I don't know. So I always tell people, don't worry about whether you think market's going to go up or down. It's kind of fun to read it and kind of, see if you can predict it. But just realize that 8 o'clock, the market's going to move, and it's going to probably go whipsaw up and down all over the place, and you're going to be careful. But then afterwards, we're going to see if we can't catch a trend. All right. But nonetheless, we can try and catch maybe a little scalp and trail here before the market. So let's talk about scalp and trail. So that's our news. 8 o'clock, we got some news events going to come up. So we got about a few minutes to talk here for a second, and then we're going to show you the setups that I've been using. Now, usually I use setup, in my software here. This is track and trade. Hold on, I gotta drink some tea. Man, it looks like the best market to be trading right now is the Dow, doesn't it? The Dow's doing really well. The Dow's been just kicking butt lately. It's been doing really well. Yesterday when I was trading, I was doing the S&P or the NASDAQ on range 20. So I wanted to kind of stick to what I did yesterday. But man, that Dow is very attractive, I must say. Very attractive. All right. Now we need a market to move. We can't make money in a flat, dead market that doesn't go anywhere. But I want you to remember that what we're looking for when we trade, and I'm going to bring this up on the screen one more time for you guys. I know some of you guys that have been here with me a lot get tired of looking at the same thing, but we do the same thing every day. That's what trading is. That's one of the nice things about trading. We just do the same thing every day. It's also one of the bad things about trading because we just do the same thing every day. All right, but we're looking for recurring price patterns. We want to be very cognizant of where we're going to get into the market and where we're going to get out. It's very important that we do this. But this is a strategy that we're going to practice today. It is a reversal strategy. So we have to be mindful of when the market has a tendency to reverse. We know that it goes up and sometimes it reverses and comes right straight back down, or it goes down, turns around, goes right straight back up. But sometimes it makes little jigs and jogs and it doesn't go straight up or it doesn't go straight down. So we have to be very, very careful with how we get into these markets. But there's dozens and dozens of different types of of patterns that we want to watch for, right? And you can learn all of these, or you can just learn one or two of them. And I would say in the beginning, just learn one or two and get to be good at those. Now, we're going to kind of stick with today the easiest patterns. We're going to stick with these little decision points like this. I call them decision points because the market gets to a point and then has to decide whether it's going to go up or down. And we want to play the decision points. Okay. So again, there's lots of little decision points that you can learn, and you can trade many of them, but we don't want to try and learn all of them. We just want to learn the easiest ones, right? So there's some easy ones that are pretty simple. Like this is a pretty simple one. Let's see. This one here is pretty, not that one. That one's not simple. This one's a pretty simple one. We like this one a lot. This is pretty simple. Now you'll see this, kind of little concave, convex moves to kind of give you an idea whether the market's going to go up like that or if it's going to curl over the top and just roll over. So there's those little moves like that. Here's another one. It's kind of basically the same idea. We're just looking at it in a different way. A lot of these are very similar. It's just how you approach them. And so just be mindful that this is what we're going to be looking for. And if you would like this little booklet right here, this little PDF that I'm showing you with all these different, it's got all the slides for all the presentations that I give. And it's getting long because we've been doing this for a while and I've got a lot of little slides in here. But if you want this, you just scan it right there with your little phone. Just take your cell phone, point it at that little blue square, and with your camera, like you're going to take a photograph. So bring up your camera and point it at there. And you don't have to take the picture. You just point it to that square, give it a second, and then a little link will pop up on your screen. And you touch that little yellow link, and all you have to do is just point your camera at that square, and this document will come right up on your cell phone. All right. So you can have this document. I don't even ask you for your name, your name or email address or anything. I'm not into that. I don't send out emails. I hate email. In fact, the other day, I'm going to tell you, I tell you what a curmudgeon I am when it comes to email. On my email thing, the email inbox, they have this ability to put on an email when you go on vacation that sends a reply email automatically and tells everybody, hey, I'm on vacation. I'm not going to see your email for next couple of weeks. If it's important, let me know. I just turned that on permanently. And instead of saying I'm on vacation, I said, I get 10 gazillion emails a day and I don't read my email. So if you're sending me something that's important, you better text me, call me, or send your invoice in the sneaker net or by the real mail system, paper mail, because I don't have email anymore. By having 10 gazillion emails come in a day, it just nullifies your email inbox. You don't have one, right? I mean, what good is it if you get 10 gazillion emails a day? So I can't read them all. So I just gave up. I just gave up. I don't even have email. I do because you have to have it, right? I mean, every time you sign up for something or you have a credit card or something, you have to have an email. But I just put a permanent, I'm on vacation notification, only I took off vacation and just said, I get 10 gazillion emails a day. If you send me something and it's important, you better notify me another way because I ain't going to see it. So that's why I don't do emails. And that's why I'm not asking you for your email because I'm not going to send you an email. If you want this thing, just go get it. It's free because I don't ask for emails. Now, I do ask for an email if you're going to sign up for something. I've got Pit News Magazine, and I'm going to publish something very important in Pit News Magazine. This is the disturbing news that I have that I want to talk to you about. It's not really disturbing. It's just more information that we need to know, but something that kind of throws pie in our face in what we've been doing a little bit. So I'm going to publish it in Pit News Magazine. So if you're going to subscribe to Pit News Magazine, which everybody should, first 3 months are only $1, and then it's only $50 for an entire year after that. And this is where we publish all of our findings of the things we do here on this YouTube class. Of course, it's got audio. You can read the articles and you can watch them. So I would highly recommend you go get Pit News Magazine. And I will ask you for your email there because we do send it by email. So you're going to have to pay very close attention every month for your Pit News Magazine. All right. Comes out on the first Monday of every month. That's not always the first day of every month. It's the first Monday of every month. Now, sometimes the first day comes out on a very opportune time, and we might send it out on the first day of every month, but usually it's the first Monday of every month. All right. So Sometimes that gives us an extra day or two to work on these things. We work overtime on this Pit News magazine. We just have a whole staff of people working overtime all the time. It takes an entire month to put out a magazine. So what are we going to do? We're going to scalp and trail. So let me show you down here. I got down here in track and trade, and that's why I brought that up, because I want to show you track and trade. This is track and trade. This is the software we're using. So if you want to use the settings I'm using, go get this software. Again, there's that little thing. You can scan that little code with your camera, but the problem is it's just going to take you to that little square is going to take you to the, if you're using your camera phone, it's going to take you to the camera phone version of the internet, and track and trade it's not an app that runs on your phone. So you can't really do anything other than just, make note of the website. You got to go there with your actual real computer and download the software. So this is the software we're using, and that's why we have these OCO order buttons over here, and I'm going to show them to you right now. I'm going to show you my settings. So the scalp and trail, you notice that I usually we've been doing number 1 a lot. I've changed it a little bit to number 2 to accommodate the NASDAQ, and I'm going to come in here and I'm going to pop this up. And Kirk right there, very nice. Says, I am a track and trade user, love it, but still learning it. There's a lot to learn. We've been developing on this software program for 20 years. So we incorporated in 2000, 24 years ago. So it's a very robust software program. It's been around the industries. Very well aware. We've won Stocks and Commodities Annual Reader's Choice Award 7 times. And when you do that, everybody starts copying all your stuff. I can go around to every single program in this entire industry and point at things that they stole from us. Everybody stole from us. We've been around longer than almost everybody. There's 2 or 3 programs out there that longer than us, but not very many. The reason I created a software engineering firm to write software in the first place was that I hated all the software that was on the market. It wouldn't trade the way I wanted it to. And it's like one of those things, you hear me complain all the time about software that we're using. It's like, if you want it done right, you got to do it yourself. So I did. I said, all right, if you want it done right, and this is something I love it more than anything else. I don't want to do anything else. I want to do this. And I want software that'll work the way I want it to work. So I want to be able to tell the programmers what I want. So I said, let's do it. So we committed, and for 24 years, we've been working on this piece of software, believe it or not. It's come through a lot of iterations and won a lot of awards, and we've invented a lot of the stuff that's in this industry. So there's programs out there that have way larger user base than us that actually just copied us, and almost down to I won't get off on that. The people copied us, and actually, because we're such shitty marketers, I got to admit, we're shitty marketers. We don't know how to tell people what we're doing. And we're good engineers, but we're shitty marketers. And people steal our stuff and then do better than we do with it. So it's kind of frustrating. But nonetheless, happy for them. Glad you're kicking our ass with our information, with our technology, for stealing our technology and then kicking our ass with it. Okay, I'm not bitter. not bitter at all. All right, so here we go. Let's come in here, and I'm going to show you number 2. So I'm going to flash this on the screen just for a second. So grab your cell phones and take a picture of it. Now this is like clay. All right, it's moldable. You can change it based on what the market's doing. There's never anything set in stone. It just happens to be the one that I kind of formulated yesterday, and it worked quite well. Is it going to work this morning as well as it did yesterday? I don't know. The markets are going to be different. It's a different time of day. I had one student come in to me, and he's like, man, Lan, I was trading and I was making so much money for the first couple of hours. And then I decided to flip over and start to do the same thing I was doing with real money. And then I lost a whole bunch of money. And he goes, I don't understand what happened. I was making so much money. And then I flipped over to real money and I started losing all the money. I said, well, the one thing you changed was the time of day. You were making all kinds of money in the morning when the market was running and doing well, and then you decided to do real money in the afternoon when the market was slow and quiet. And so that's what you changed. I didn't change anything. Oh, yes, you did. You changed the time of day that you traded. And that was what you changed. So be mindful of that. Time of day is very important. Okay, so that's the first one. Okay, now I'm going to come and show you that's the scalp. Now I'm going to show you the trail. So we're going to use these in combination, one with the other. So there's the other setting. All right. Take a picture of that one. I'll leave it on for the screen for a second, and you can go and set your software up. And again, this was tailored to what I was doing yesterday, which was the NASDAQ Mini Range Bar 20 with Heikin Ashi bars. And that's very important too, because that's what this was tuned for. All right. I tuned the market to these settings. All right. So now you got those settings. Go ahead and I'm going to hit cancel. And if you miss those, well, this will be saved and it'll be a recording, and you can go out after the class is over and rewind and go back and take pictures of those. So again, we're going to be looking for opportune times to be getting into the market, and we want to try and remember that we got trends and counter trends, trends and counter trends, and we want to be mindful about when we're going to get in and execute this strategy. And that would have been a beautiful place to execute the strategy and catch that big long move right there, right? But we didn't. So what's the market going to probably do? Well, it's going to probably come back down. It's going to probably make a little bit of a retracement at some point, break those blue lights, and when that happens, we want to grab it. Right now, it's going to probably be a counter trend, so it'll probably be choppy. See, but sometimes it makes a reversal and just goes whoo, and that's really beautiful too. So we're going to try and capture that, and I'm going to drop my scalp in there, and I'm just going to scalp out not very much money, and I'm not going to do the trail this time. So we're just going to scalp, and we'll add the trail later. So I want to do scalp, and then we'll just do the trail, and then I'll do scalp and trail. So we're going to just sit here, and the way this works is that it trails up one price bar back. So the name of the game is market makes higher highs and higher lows. All right. And that's an uptrend. And when it makes lower highs and lower lows, that's a downtrend. And that can happen in longer term series of trades. So this here is an uptrend because it's making, there's a low, there's a high, there's a low, there's a high. All right. So this is a uptrend. So higher highs and higher lows. So here's your low right here, and here's your low right here, right? And then here's your high right here, and here's your high right here. Okay, we're in the market. We're going to see if it's going to. Now remember, I am a very much, and if it doesn't immediately go in my favor, I just get out. I don't play the game of, and sometimes it turns and flushes anyway, but it didn't go immediately. On my scalp, I want it to go immediately. Now on the trail, I'm more conservative. I don't expect it to go exactly immediately. Now that would have been a profit if we wouldn't have sucked our stop in so quick. But it's dilly-dallying around up there. It didn't just drop for me like I wanted it to. So, but anyway, this is higher highs and higher lows, right? So here's a high. So this high is higher than that high. This low is higher than this low. That means we're in an uptrend. Higher highs and higher lows. But we also do that on a smaller term basis. All right. So on a 1 bar basis. So here you have a high, and then here you have a low, right? And then here you have a high right here, not that one, here. So we go at a smaller little basis, like higher highs can be right from an individual price bar, right? This was a low, and then this was a high. It broke the high. First bar to make a new high. So what we're going to do is we're going to trail, and this market's just going dead sideways. See, it died right there. And that's the death of any trading strategy, especially a scalper. The market starts to go sideways like that, higher, big topping tails and bottoming tails. This is what a scalper trader like we're doing today wants to see. It's got to be a market like this. If it's a market like this, you need to sit on your hands. Okay, so we took one shot at it, and it did that to us. So that's bad. Don't trade through that. That's going to kill you. All right, we need to wait for the market to be making these types of trends, which, you know, it kind of was. So we took a shot at it, and it failed. So now we have to wait for the market to start to move a little bit more and give us an opportunity to get into the market. We want to see it move before we start implementing this. But you have longer term. The point is that we have longer term trends, higher highs and higher lows. And when you're scalping, it's higher highs and higher lows based on each individual price bar. Okay, so it's breaking higher once again. These are the magic blue lines that are telling us the market's breaking, going to go up. So what we want to do is, if we think this market's going to continue higher with this longer term higher highs and higher lows, We can look for an opportunity to go long, or we can trail up behind it and think it's going to fail and come back down. So this one is trailing up. See the flat bottoms, flat bottoms? So I've got this auto trailing order on here, and that's what the QOCOs are. That's why they're programmed in there. And what they do, see, what they do is they trail the price bars back in this case. This one's going to trail one price bar back. So we're just trailing, looking for a lower low, right? As long as it's making higher lows, we won't trade. We're not in the market. We're just trailing with an auto trailing stop for the reversal. And we only need it to reverse in this case because we're scalping 9 ticks. Now, 9 ticks is it's $20, right? Or is it $10? Let's go see. In the key, 1 tick, 1 minimum move is $5. So 5 times 9. That's how much we're going to make. All right. So that's what we're shooting for. So then with that, tried to break the previous low, and if it fails, we'll just stop and get out. And it failed. It just jabbed us. Now watch it coming back down, the rotten little market. And it turned for us anyway. We got to add, that's the scalp side of it. Now let's do the trail side of it. The trail side is the same thing. It's just not as aggressive, but we don't have a limit order to take profits. So this one, it's a real tight stop, and I've done that on both of them, and it worked great yesterday. We'll see if we need to loosen the stop up a little bit in the morning session. I don't know. Okay, blow this up a little bit. Okay, so this is the trail. Now the trail doesn't have a limit to take us out and doesn't take any profits. So that's why we do a combination one with the other. We do a scalp and a trail. And usually what happens is the market will move far enough. It's only 9 ticks. It only has to move 9 ticks. Like that, and failed again. What an ugly little market. Look at all those topping and bottoming tails. Well, now we're down $180 already. Lots of topping and bottoming tails. We got 5 minutes until the news report. Market's a little nervous. Look at the low volume for right now, too. We just want the market when it moves to move, not have all these topping and bottoming tails. This is really super ugly. And yesterday in the afternoon session, it was beautiful. It was just snaking right along. And when it curled, it just kept going. And when it curled the other way, it just kept going. Sometimes I think in the morning session, because there's so many people trading, we have more market makers in the market too. Market makers stop trading in the afternoon. We get less of that kind of reversal stuff, I think. That's why oftentimes I don't trade in the morning sessions. That's why I have these classes in the morning session, because I don't generally trade real money in the morning session. Because you get a lot of this stuff. Nasty. We'll see though. We're practicing. We're learning. See what we do. All right, but we want to combine the two. We want to do scalp and trail so that we get our scalp. And the reason we do the scalp is because it's, if the market doesn't have to move very far, all it has to do is break the previous low, which is the first candle to break a new low or the first candle to break a new high. And then it only has to move 9 ticks to take enough profit to cover us if we lose on the trail. If it comes back and stops us out on the trail, it ends up being a break-even trade. But the market's got to move at least 9 ticks. I mean, goodness sakes, stupid market. If you can't move 9 ticks, it's not worth trading. So let's see. We're coming down now. Let's see. We're going to put the scalp in for the upside, and we'll put the trail in for the upside. Now, if the market's coming down, it might get a little rebound and then turn and fall once again, right? We often get that. And we may be trying to take a long position at not a opportune time. The pattern might be like this, right? When you're trading, you don't want the tool lock on. But when you're teaching, you want the tool lock on. So we might get something like that, which would make us lose money again. But we'll see. It's like, Land, you should be short. I know. We tried to get short up there and we got stopped out. It didn't roll. Okay, so now we are trying to get got stopped out again. It couldn't even go 9 ticks. But we still got our trail in there. It's only if it goes long, though, it's going to fail to. And we got to get one more bar up, a close above. Look at that rotten little thing. Wow. Okay. Well, we can't do this until we get that. Okay, we'll just do it right there. This one. And I'm manually placing this one in here at this point. We'll see. Now, if it flushes and falls, then we go short. You're trying to go long. Now watch it take off and go to the moon straight up without us, and we got stopped out. That's a nasty little market. Nasty little market in the morning. That's why I hate the morning session. It's a little bit tougher to trade. Look at that. Okay, we got 1 minute till the bell, till the news report comes out. What time is it? 58:96. 2 minutes. It's just trailing one price bar up, just doing the same thing. Still looking for the reversal, but I want it just to immediately just kind of go right through it. Whoosh. And if it doesn't, if it starts to pop back, that's not a strong enough market for us. We just get stopped out. And I was worried about that. I was like, well, I got this all tuned in for the night, for the afternoon session. And then we go do it in the morning session where we got more volatility in the morning. It might get stopped out too many times. We might have to loosen up those stops. Okay, here comes the. All right, there it is. Let's get rid of that for a second. There was our news event. See what they decide. Is it good for the market or bad for the market? All over the place. Time to digest the numbers. Here they go. It's too hard to trade right now. So what'd they come in at? Forecast was 72. They came in at 65.6. Michigan consumer sentiment. So bigger numbers are better. Consumer sentiment went down. So technically speaking, the market would fall. We ready to throw our hat in the ring? One good trade. We're one good trade away. Okay, so we're coming down. Oh, I got it. Didn't get it in there in time. Try and catch the reversal. You have to do two of them if you can do scalp and trail. You have to push two buttons. Okay, there we got our profit on the scalp. Now we're going to see if it won't trail. So what did we scalp? Here's the closed. So we made 30 bucks. Usually we get more than that on the scalp, but man alive, it's slipping today. Okay, trail. Now we just need the market to give us a lot of flat bottoms. Nope, it's not going to do it. So now we have to wait for another setup. Man, it's a rotten little bugger. Choppy, choppy. This went so fast. Okay, what's it going to do? We got this high right here. Is it going to break across that? We'll see. We'll try and take it short if it fails. Okay, we're auto trailing. So once you put it in, okay, we scalped another 42.50. Man alive, that's not giving us very much. Okay, now we want it to trail a little bit. Don't come back. Don't come back. You dirty, rotten little thing. Just flat tops, flat tops. There we go. Come on. My goodness sakes. Okay, you know me. I like to just get back to break even. 207. Come on, take it. Take it, you rotten little booger. Take it. There we go. All right, so we're back to $30 profit. We can kill this one. Len, you should have stayed in. Now look, the market's going to fall. Hey, you know what? We get 7 more hours of this. Don't worry about it. Don't worry about it. And you do better when it calms down a little bit anyway. All right. We're bouncing off the, is that the 200 period moving average? Okay, should we see if it's going to reverse and go back up? We'll throw one in here for a reversal. Okay, so we've got the scalp and the trail on, not just one. We're doing both. The scalp helps pay for the trail. That's why the scalp's important. It's not that you're going to make a whole bunch of money just scalping $10 out of there, 10 points out of the market. It's not where you make all your money. The scalp just covers it when you lose on the, get stopped out on the trail, and it helps you cover the costs. If the market will move just far enough to scalp, covers your costs, covers your commissions. Okay, covers, commissions are paid for. Now, if we get stopped out right there, see, we got stopped out with a $25 loss, but our scalp paid us $45. So we covered our commissions and fees. That's all that really is. The scalp is really to try and just cover commissions and fees. When you're wrong, it's got to move far enough to cover commissions and fees. If it won't even do that, then you're going to kind of get a really crappy market. And it's tough right now. I'm going to admit, this is not as smooth and clean as I like it. Now, will this work over on the Dow? You say, well, Land, can you take it over and go to the Dow? The Dow seems to be a little smoother. Well, I don't think these settings are going to work on the Dow because, first of all, this is a range bar 6, and the Dow is a lot smaller market. I have them tuned for the other market, so you're going to have to make adjustments. So let's try it. Let's see. Let's come in here, trade. Let's drop in there and see the difference. See how much farther the market has to move? But it looks like the dollars are the same. This is still a range. This is a range bar 6. The other one was a range bar 20. So what did I put on there? That's the scalp. We need the trail. The trail doesn't have a limit, and it doesn't move as aggressively with the stop. The stop doesn't move as aggressively once it gets filled. So I think this might work just fine on the Dow, on the different market. This is range bar 6. These settings might be universal. We'll see. I didn't try. We're going to get stopped out. This market's not going to rally. Come on, rally up there. Don't be lazy. No lazy markets. There we go. Touch it. Touch it. That's only $45 right there. Okay. Got our 45 scalp. Now we got our trail. Our trail automatically moved up to break even. So if it comes down, stops us out, it's free trade. Now, anything above this, now we can turn this off so it doesn't trail at this point too. We can just tell it to trail to break even and then just sit there and then just let the market go, right? And it could go forever and you could make hundreds of thousands of millions of dollars because you got in at the right opportune time and the market just took off and went to the moon and you kept your stop at break even and you didn't trail it up. because if you trail it up, well, it's going to stop you out eventually as the market kind of makes a little kickback, right? Okay, so just kick this back again. So we made, in that case, $70. But now watch, if the market continues to roll, then you're like, well, you shouldn't have got out. Well, you're correct. We should not have got out if the market continues to go up. But if it didn't, then you're going to be glad you got out. But maybe it only comes back a little bit and continues to roll. So what you do if you're going to trade that idea and you're going to say, well, I want to stay in longer land, all I want to do is get to a point and then I can go out to a longer term time frame. This is a range bar 6. Maybe I then want to go to a 1 minute chart and then out to a 2 minute chart and then go out to a 5 minute chart, out to a 10 minute chart. Trade longer and bigger trends, right? You can do that. All you do is you just make an adjustment to your number 2 strategy here, and you can come in and you can say trail to break even. So again, like I said, this is just, it's like clay. It's moldable. You can change it to do whatever you want. So you can say, well, I want the scalp and trail just to trail to break even. Once it gets to break even, I don't want it to continue to trail up. I just want to let the market go, because at that point it might go to the moon, even though it pops back a couple of times. You can do that. All right. You can also tell it to trail. Now we got it set to drop the stop at 10. You can adjust that so it's a little bit further back, a little bit closer, whatever you want, depending on the market you're trading. But you can also then tell it to trail on something different. Like in this case, we got the yellow dots in here, and they're a little bit less aggressive than one price bar back. So we could come in and we could say, well, I want it to be on the ATR. Now I want it to trail on the ATR instead of one price bar back. Okay, well, it's going to still drop it at 10, but then it's not going to scoot up there as quickly. It's going to wait, and it's going to go on the yellow dots. But only, oh, spilled my tea all over my desk. I'm not paying attention. Disaster on the deck. Still got a little. All right, so that's the name of the game here. Let's see how that works. We're going to come in here, go okay. That's the scalp. We got now change that. So the trail. We've done this. The trail is now going to trail on the ATR instead of one price bar back. So it's a little bit less aggressive. And I've got it set to 0.7, which is a pretty aggressive ATR. Okay, so we got a little pullback, a little pop, break. Again, we're watching for these patterns, right? We're watching for these patterns. So this is the pattern that I'm looking for right now. I kind of like these little patterns like this. These little patterns like this. See, I'm just looking for this one right here, the little shelf pattern. That's kind of my favorite. You got some others that look kind of like this, little decision points. A lot of them are the same. They're just kind of little changeovers from market direction. All right. So that's what we're looking for. So a little reversal pattern, maybe a market turn and come back up. We can just trail one price bar back. We'll drop the other one in there. Okay, we got popped. Now is it going to go? Popped on the reversal. Now you notice too, another thing I was doing yesterday, and I'm not sure that I'm convinced that it's the right thing to do. Oh, we're going to get stopped. It popped back and it's not going to continue. Not even enough to scalp. A lot of you are aware that when I do this, I like to have this be on when I'm trailing price bars back 1.1. And I didn't do that yesterday because the spread was so tight, I didn't need it. But in these morning markets, we might need the 0.1 right there, which is actually gives you a little buffer, the distance of one minimum move, which is the buffer of the spread. All right. So I'm going to put that back in on this one. Oh, that's cancel. We're going to do number 2. So we're doing number 2. Number 2 strategy. And I'm going to make that 1.1. Well, we got stopped out. 1.1. But that's going to make you have a bigger loss if it's wrong. And then it's going to jump 1 tick. That's not price bars. So we're going to, okay, I'm just going to change that price bars back to 1.1 right there. And I'm going to do the same to this one. I hate it when it pops in front of the chart. 1.1. Not 11. 1.1. Okay, that's going to add a little buffer in there. Maybe that'll help. Maybe that'll help us here in this more. Look at the switchovers. See, we're getting a lot of, in the switchovers, we're getting a lot of this kind of stuff, which we have to prepare for, manage our trade. That's the counter trend coming back up in the overall longer trend. So the trend's down. We're getting choppy, chop, chop, chop on the counter trend. It's not as smooth as I was getting it yesterday, but the downtrend is really nice and smooth. If you could catch that, that's a lot of money in there. So we're just trying to catch these reversals, but it's being choppy on the counter trends. It's not being as smooth as I like it. Like I said, these morning sessions sometimes are a little bit harder to trade. The afternoon session doesn't have as big of moves. The market doesn't move quite, these are big moves. That's $205 move. Sometimes you don't get that big of a move. Sometimes you do, but oftentimes in the afternoon session, you don't get this type of a choppy reversal either. It doesn't chop quite so much. Sometimes it's a little bit smoother and you can catch them a little easier. Now that was a beautiful one and we weren't trading it. I was not paying attention. That was a perfect reversal right there. That's what you're looking for. Trail, first candle to break a new high, bam, and it just went right back into the other direction. That's exactly perfect what you were looking for. Now we're getting a little stop out here. Now the question is that going to be a perfect down or is it going to be another one of these little choppy little sideways things here? Let's see, ugly. Ugly. We can try and get it right here. Got to be fast because you got to put both of them in there. Now is it going to go? We need it to fall at this point. Not back off on us. Fall, buddy, fall. No, don't do that. Don't go back up there. You rotten little thing. We're getting both of us stopped out. Well, you should have gone that way, Lan. Why'd you go down? The arrow's pointing up. I thought I was going to come and do one more down here. It's bouncing off the 100. That's the 50. Look for the reversal one more time. Yeah, everybody gets a guess. If you thought it was going to go up, then you should have gone up. I went down. Now I got the arrow from the bulls and bears pointing up. So anything coming down is going to be counter trend. Come on, one good trade away. You just need to catch a trade, catch a trend. Boy, look at it go. We've picked the wrong direction. Remember what I always say. You got a 33% chance of being right. Market can do three things: go up, down, or sideways. You got to pick one. Doesn't matter what you pick. You only have a 33% chance of being right. %, chance of being right. Look at, oh my gosh, this is FOMO. This is horrible, making me feel terrible now. Look, we picked the wrong direction. And it was a setup too. Look, I could have done it. I could have put it in there right there. I could have put it in right there. That was a lower high and it turned and rallied and boom, straight up like a rocket ship. And here I was trying to catch the reversal, which is probably not going to come immediately. We better kill that. Now watch it turn and flush right straight back down without giving us anything but just a straight reversal, and I got out. Killed my position. Wow, look at that thing go. We missed it. Holy cow! FOMO. Oh, land. You suck at this. Oh my goodness. Look at this market go. Uh-oh, I didn't get my trail in. Well, good thing, because I'd have lost it. Why aren't you long, man? Well, that wasn't a good setup for long. I need 2 bars. 2 bars to come. There's 2 bars up. I could have taken that one. Good thing I didn't. Starting to die up here at the top, right at the 200 period moving average. You can set the same strategy up and trail on little yellow dots instead of one price bar back. So it's a little bit more conservative strategy. So set that up as number 3. See, I got that in here as a different number. So one of these other ones, so this is number 3. It'll trail on the yellow dots. But we're running number 2 right now. So number 2 is price bars back. So you can set these all up and have numbers on them and not be so aggressive. I was really aggressive going price bars back as opposed to on the yellow dots. But you can trade the exact same thing with the yellow dots. Scalp and trail, scalp and trail. Got right back to the 200. Oh, Len, you picked the wrong direction. Did pick the wrong direction. Should have been counting. I'll bet it was 3 drives down and that thing reversed on 3 drives down. I bet we go back and look at it. Okay, we're trying to take the short. Come on, scalp. You can go far enough to at least give us $40. Okay, we got our scalp. Now we need the trail. Okay, here comes the trail. Now we're trailing on the yellow dots, not on the price bars back. If we were price bars back, we'd be down closer. We'd be right behind that little price bar. And if it reverses right here, bounces off those moving averages, the 50, and comes back, it's going to stop us out at break even at this point. But it held our stop back further, and we could have maybe gone down, but it was rotten little market. Didn't do it. It's going to fall again. We took another short on it. Nope, stopped out. Got in there late. I'm way over trading, guys, but I'm doing it because this is financial entertainment at this point. Hopefully you're a little bit more cautious, a little bit more careful with your decision point trading. Oh my goodness, look at this market did it too. This one even gave us another opportunity to get in here. Oh, it's going again. Oh my goodness, I missed it again. Len, you suck at this. I know. Come on. Everybody's better at it than me. Look, the bars are green. You should have known it was going up. I know. Okay, let's give it a second. There's an opportunity to get in right there. See how it has lower highs? But I don't know if I'm scared to get in long. Feels like we're chasing it. But the reversal doesn't want to come till it crosses those blue lights. Those blue lights are coming way back here. Why didn't you have it in there, Lan? You should have had your trail right there. You'd have been in the market short right there from that point right there. I know. Oh, it would have worked too. Which direction the market's going to go? Oh, it just reversed right around. Maybe it's going to go back up. I'll put them in up here. Uh-oh, didn't like that. Exit chart. Try again. Oh, I don't. I set that up for the ATR, and I don't have the ATR turned on. So I have to come back down to 2. Change this back over to price bars back because we went over from a different market, right? Oh, well, there's your scalp. We got the scalp in, and I didn't have the trail in because I was dilly-dallying around. Is it going to trail for us now? Scalp and trail, Land. Scalp and trail. You missed it. You missed the big run. I know. I would have made it if I was trading. I would have got that big run. I saw it right there. I saw the little lower high and lower. I listened to what you said. Higher highs and higher lows and lower highs and lower lows. I'd have got it. It was green. I knew the market was going to go up, and you turned and tried to go down. I know. Gave up all my profits on it. I'd have been long on this one too. I'd have been trailing back down the other side because I know the bars are green. You should have been going long. What are you trying to go short right here for? I'm just trailing on the price bars back. Why aren't you trailing the other price bars back? Trade the counter trend, Land, not the trend. You're trying to get a reversal on the trend. That's going to give you the counter trend. Why are you trying to catch the counter trend? You're supposed to be catching the trend, not the counter trends. I know. We don't trade the counter trends. How many times have you told me that? Don't try and catch the counter trends. The trend is your friend until it bends or ends, and all you're doing is trying to catch counter trends. I'm trying to catch reversals. How many times have you said not to catch reversals? I know. Look, right there's your opportunity for the long position. Put it in there. What if it goes short, though? What if it goes long? That's a long position on a long trend. Okay. I'll try it. I got it going both ways now. I don't care which way it goes. If it goes down, we'll make money. If it goes up, we'll make money. If it goes sideways, we'll lose money, and a lot of it. All it has to do is move one direction or the other, and we'll make money. But if it's just dillies around and starts to go sideways right here, which, there we go. We're going short. Yeah, but it's the counter trend. Well, at least our stop's to break even. And now we're trailing down with the reversal. Okay, well, that could work too. So what'd you do there, Lan? You just bracketed the market. I had a situation where the market could have gone long or short. There was both positions available, and so I put one on each. All you have to do is catch one good trade. We're one good trade away from being rich beyond your wildest dreams. Let it rip. Oh, well, there you go. You just got stopped out. When you're trying to scalp to the upside, well, I guess. Now that didn't work. Kill that. You just lost half the money. I should have taken that one that was trailing back off. There's a good lesson for you, Lan, right there. If you go bracket the market, take the other opposing side off and reset it yourself. Otherwise, it's going to, well, there was a quick scalp. You didn't get your trail in there. Hope the market doesn't trail and make you feel bad. Look at the blue lights. It's coming down. It wants to come down. I know it does. It wants to come all the way down to the 200 period moving average. Do you feel like you're overtrading, Lynn? Yes, I do. All right, stop then. Okay, we'll stop for a little while. That's $215. I guess we can't cry about that spilt milk. Let's go put on our option strategy. Okay, let's come over to the S&P, and that's the S&P 2-minute chart. And here's where I wanted to tell you about the thing I learned. Now, how many times have you guys seen this? Let's go say hi to a few people before we put on this option strategy. The Kirk Schwartz coming in at number 1. There he is with the gold. Michael Bruce coming in with the silver, and Gary Thomas coming in with the bronze. Matt Baker bringing up the tail at number 4, and we got Bruce R coming in there saying good morning. How are you guys all doing today? Thomas Shaw. We got Kirk, I hear you about emails. You feel the same thing about emails, Kirk? I got so sick of emails. I just finally told everybody I'm not reading your email. If you send me an email, you have to send me also a text message that says I sent you an email. And if you don't have my phone, that means I'm probably not going to read your email anyway. Probably don't know who you are. Probably spam. All right. Pit News Magazine is awesome. Yes, Bruce, it is. And I would suggest everybody get Pit News Magazine. Pit News Magazine? What's Pit News Magazine? I've never heard of Pit News Magazine. What? What do you mean you've never heard of Pit News Magazine? Pit News Magazine is the greatest magazine in all the world. All right. This is a digital multimedia magazine where we put all the stuff. It's just specifically for traders. It's $1 for 3 months. If you don't like it after 3 months, hey, I'll even give you your money back. It's got a 90-day satisfaction guarantee. If after 3 issues you don't like it and you want your $1 back, you say, I wasn't worth $1, I'll send it back to you. And then it's $49.95 after that for an entire year, 12 more issues. So for $50, you get, what's that, 12, 13, 14, 15 issues of a multimedia magazine for $50. You can't beat that. You can't beat that with a stick. Go over to pitnews.com and register today. All right. So let's talk about why this is important. Okay, let me bring this back up. How many times have you guys seen this chart right here? I have showed it probably a million times, right? You guys have seen this thing here. What does it say? Calculating the delta Kona probability, aka the 68, 95, 99.7 empirical data distribution rule. Now, if you take statistics in college, oh, I forgot to say hi. I'm taking track. Let's see. Okay, here we go. Michael Bruce says he does bring up the rear. He's bringing up the rear, Michael Bruce. All right, so back to our calculating the delta Kona probability. The empirical data distribution rule. I didn't make this up. All right. Just want you to know. This isn't something I made up. If you go to college and you take statistics, they will teach you this. They will teach you the empirical data distribution rule. It's, one of the first things in chapter 1 of your statistics class. Approximately 68.2% of the time, data falls within 1 standard deviation of the mean. Around 95.4% of the time, data falls within 2 standard deviations of the mean. And nearly 99.7% of the time, data falls within 3 standard deviations of the mean. What does that mean to us? If you're going to calculate any level of distribution of a stock chart, for example, 68.2% of the time, it's going to fall within 1 standard deviation of the market. And so we build our option strategies off of that knowledge, right? We come in and we say, well, any market that we're going to trade, 68.2% of the time, it's going to stay inside of 1 standard deviation. Okay, that's great. If that's the case, what am I going to do? I'm going to be more likely to want to sell premium and collect premium because it's going to stay inside that 68.2 standard deviation. I'm going to be very likely that I'll get paid off on my options premium, right? 68.2% of the time. I only have to hedge outside of that roughly 30% of the time. Well, Land Turner, I don't believe anybody. Everybody's lying to me. Everybody's telling me lies. So I have to go and prove everything to myself because I don't believe anybody. I know you're supposed to stand on the shoulders of great people and trust the work that they've done before so that you don't have to redo all the work. But I'm not that guy. Not when it comes to my money. All right. I want to prove it myself. So what did Land do? Well, yesterday, Lance spent a whole bunch of time doing his own statistics and mathematical modeling. And guess what I found out? Now, I'm not going to dispute this, that on average, 68.2% of the time the market falls out of that standard deviation. But when it comes to doing our options, we're not working with a one standard deviation. Kind of feels like we are, right? I mean, and sometimes we might be, because the market is dynamic and it changes and it moves. So if you're going to take your one standard deviation tool, and we can either use the RAF indicator, okay, there's the RAF, and we can come in here and we can go to the preferences and we can tell it we want it to be normal, which is one standard deviation, or you can do two standard deviations and it's different. I don't understand how it's calculating that, because one normal, I guess, and then this is two standard deviations. So this would be your, and it's, I guess that would be your one standard deviation. It's one on each side, so that's why they count it as two. So one standard deviation to the upside, one standard deviation to the downside. And you can see that when you put that out there, yes, it's stayed in there. Historically speaking, it stayed within that two standard deviations all the way up through that trend. Pretty cool, right? And it hasn't left it yet. And 62% of the time it stays in there. Okay, so here's what I tested against, because I'm saying, okay, that's awesome. But we're trying to figure out how often we have to hedge and how strong our hedge has to be on our options, right? Because given that number right there, we don't want to be buyers of options. We want to be sellers, because it's telling you, hey, it's going to stay within this two standard deviations 70% of the time. So you want to be selling premium and collecting the premium. You don't want to be buying it, because if you buy it, it's 70% of the chance it's not going to leave that standard deviation. Okay. But when we put on our option, are we going to be actually trading a two standard deviation? A one standard deviation, one per side? No. Why? Come to your options chain and look at this. Now, here's what I did yesterday. I was like, well, wait a second. How big is one standard deviation? Now, in this case, one standard deviation is $500. All right. Now we're going to come in here and we're going to go to our 0 days till expiration, because we're just going to do a 0 DTE. Now look, it's $500, and that almost works out to be perfect, right? So we come in here and we sell this one. And if we sell this one and we add those two together, what does our amount of money end up being? $1,000. Well, in this case, look at this. Amazingly, that's your 400, that's your 1,000, that's your $1,000 standard deviation right there. I mean, it almost seems too good to be true, right? If that market stays within that one standard deviation, and we're going to do it from where we buy the market at, so we're going to do it like this. So we're going to come in and we're going to say, okay, 500 to the downside, 500 to the upside, and then that's our $1,000. And then we need to have the market stay within that one standard deviation. When you do that modeling and you see it like that, you're like, oh my gosh, I'm going to be rich, rich, rich beyond my wildest dreams. I've never seen anything so beautiful. And this is what Land's been teaching for the last little while, right? We've been looking at this, and this is what we've been trading. I want to get rid of this. Okay. So that's our one standard deviation away from our current market price. So then I started to think, all right, well, if that's our one standard deviation, and the market's going to stay inside that one standard deviation almost 70% of the time, how often does it do that on the S&P 500? Well, Ann went back and did a whole bunch of testing, lots of back testing. So now that we got that model, this is the article that's going to be published. This is it's obviously not published in Pit News Magazine, but it's almost all written. I've just about got it written. Okay. So I'm just doing the final tweaks on it. But I wanted to show you this article is going to show up in Pit News Magazine, because here's what I learned. Okay. We're going to come in here. Options trading is a powerful tool. All right. One popular strategy is the long straddle with involving both buys and calls and puts. But then I come in here and I said, recently, our analysis of the S&P 500, which is what we're putting these things on, right, revealed a compelling insight. Over 66% of the time, the market moves outside of the 45% 8% deviation of the opening price. So I went and proved this to be almost the opposite of the empirical data distribution. I went back and looked at the data of the S&P 500. Over 66% of the time, the market moved outside of 0.45% deviation from the opening price. Now, why do I say 0.545%? Because if you take this and watch this, and you come in and you turn your dollar from dollars, click on it, and you come in here and you go to preferences, and you change this to be price move in percentages, that's a 0.21%. 0.21%. All right. 0.20%. Now, if you come back and we did this back testing, the significant finding highlights inherent volatility of the market and underscores the need for strategies that can capitalize on such movements. Our analysis of the S&P 500 reveals a compelling insight. Over 66% of the time, the market moved outside the 0.45 deviation. What's 4.5? That's way down here. Now, why did I use 4.5? I did 4.5 because yesterday's market was 0.45. And I wanted to see how often the market in the S&P 500 moved outside the 0.45 deviation. Right there. Okay, so how much is that? That's $1,200. That's $1,000 to the upside and $1,000 to the downside. Right now, we are sitting at 400 and 600, which is very common. Am I not? I mean, how often have we done this? It's almost every morning, almost religiously, $1,000, right? We put these things on, it sells up for 500 on the top, 500 on the bottom, almost every single morning. It's almost the same. Just do the same thing every day. Yesterday it was 45. Today it was 21. So the market's not nearly as aggressive as it was yesterday. But I did my math off of 45, and I went back and I got the past, I think it was like 5 years of history, and every single day. So 5 years of daily data. I looked at this and I empirically checked to see how often the market left the 45 period, the 45.45. I didn't do 0.21. I did 0.45. We could go back and do 0.21. And it told me 66% of the time over the last 5 years, it left the 45%, stayed outside of it. Didn't even leave it and come back in. It left and stayed outside the 45 deviation. Losing my voice. Apologize. So this wasn't leaving it and coming back in. Anytime it left and came back in, I counted it as not leaving it. But how many times did it leave the 0.45 deviation and stay there? And over the last 5 years, it was 66% of the time. 66% of the time on the S&P 500. It's the only one I tested. So what does that do to our empirical data? This thing says the cone of probability, approximately 68% of the time, it stays within inside of it. And that's not true. Not on the S&P. And that's what we only care about. This is an empirical data cone for all data, whatever. This is not just the stock market. This is something that you get in statistics at the university. So it's a universal number, a universal code given to anything. Go count the number of leaves on a tree and it'll fall within this standard deviation. Well, leaves on a tree have nothing to do with the S&P 500 and how we're going to make money. So that's why I wanted to test and see how accurate this was for us in our particular setup. I'm going to create a new cone of probability for us, all right, for our strategy. And because of this change, we have to kind of basically, for the S&P 500 at the moment anyway, for the last 5 years, throw this out the window. And how hard do you think that is for me to do? That's hard. I don't want to throw this out the window. This has been a model that I've been taught since Chicago 10, 20 years ago. Wait, how long ago? 24 years ago. I don't want to throw this out. This is what we've always been working off of. But finally, it's taken me this long to sit here with all of you guys going through all this testing that we've been doing on this stuff to finally go and double check that and see how accurate that is for our purposes. And I discovered not so much. Not so much. 66% of the time, it leaves that cone, and it leaves the 0.45 cone. I don't know how to test I did it with numbers, so I don't know how to test the one standard deviation, because the one standard deviation is going to have to go back and look at the trend, and I don't have the intraday trends to test against. All I have is the end of day data. So based on the end of day data, it leaves that 45% standard deviation 66% of the time. Which means if we have a shorter, right, like today, it's $1,000. This is $1,200. This is $1,000 to the upside, $1,000 to the downside. That's what I tested against. If I tested against $500 to the upside and $500 to the downside, maybe I'll do that today, because that's the zero DTEs. Yesterday they were 1,000. Today they're 500. But I tested 1,000. I tested the 0.45. I'm going to go do today. I'll go do, what do I need to do for 500? Because that's what they generally come in at, right? 500. So they're usually about $500. So let's say 500. What's the deviation on that? It's only 20%. How often do you think the market's going to leave the 20% standard deviation? If it leaves the 0.45 standard deviation 66% of the time, how often do you think it's going to leave the 0.20 standard deviation? Probably a lot more than that. So technically speaking, we should not be so excited about this selling option premium, because 66% of the time the market takes off and runs. It's that 40% that kills us. Now, on the reverse side, that's what we were trying to prepare for on the other side, right? We were saying that it stays within the delta cone of probability 66% of the time. We had to protect ourselves to the 40% of the time. I think that's almost absolutely reversed for us on the S&P 500. I think we are going to break out 66% of the time and stay in 40% of the time. So we have to protect ourselves against it staying in, not out. And we should be buying, not selling. I hate that. I love to collect premium. It's my favorite thing. But we've had a bit of a struggle with it sometimes, right? Sometimes that market leaves. Now, if we go back and look at our strategy, because we've been able to hedge this thing pretty well. So we've been able to hedge this thing pretty well. If we go and look at our spreadsheet. Where is it? How come it didn't come up? Come on, Windows. So if we go look at our spreadsheet, these have been all how lucky we've been, right? How lucky we've been trading our butterfly patterns. We've really felt real confident when you get that kind of a winning streak, and then going into June again, not as good. We've had worse losers in the June, but having those types of wins, selling premium, collecting premium with a single contract. Well, not single, two, one long, one short. So selling two options. That's a pretty good track record so far for an entire month, and we've been feeling good about that. But sometimes the market leaves that cone of probability, and it gets a little scary, especially when you lose like $500, $600, $700. So that's what we've been fighting against. But in reality, but you know what? I look at this track record and I say, what if we would have been buying premium? Would we have been losing all the time? So even though the market 66% of the time leaves our cone, the 40%, I don't know. See, it just doesn't make sense. Our historical trade scenarios show that what we're doing is a good strategy. It's a good strategy. But what if it leaves? So I've been thinking how what's another way we can take advantage of this knowledge that we've just gained? So what if we go in here? And there's several ways that we can do it. And I'm going to document a lot of these. All my findings I'm going to put into Pit News Magazine. So all my research I document in Pit News Magazine. So you guys will get it. But you're watching the sausage be made in these sessions with me. All right. The end of the month, you'll get my research. And then like last month, I put a whole bunch of this research in there. And now this month, I'm going to kind of invalidate what we talked about last month. So you have to kind of keep up with what we're doing here. We're going to say, well, maybe that's not the best situation. We need to try some things. And one of the things I want to try is I just hate doing it. I hate doing this. I want to sell premium here so bad. I don't want to come in here and buy a call. I don't want to buy a call and I don't want to buy a put. But statistically speaking, that's what it's telling me I should do. Right? And we got to protect ourselves against that. So I'm going to put on a condor out here on the outside wings. So I'm going to come in and I'm going to sell out here. How many clicks? 1, 2, 3. Okay. And we're going to sell a put out here. 1, 2, 3. It's going to max our profit. Now I need to put on the outside. I need to also put, I can't do 6 on one ticket. They only allow us to put 4 on a ticket. So I have to create 2 tickets. So I'm going to do it like this. Cancel that. We're going to come in here and buy. We're going to buy our call. We're going to buy our put. And I can't do them right at the money. I'm going to do them as a little bit of a strangle instead of a straddle. So now we're going to come in here. I'm just going to mark it into these. 250 is where it's got to go. I hate that. Don't market land credit. Put it up there. 250. Okay. All right. So I didn't take it. Daggone it. Okay. Got him to take it now. So our position is currently, we're in the market. Now we're going to sell out here. So we're going to come in here and we're going to sell these. Now the question is, are we going to sell this all as one, 2, 3. Sell. There you go. 1, 2, 3. Oh, I went 4, 3. Okay. And then I'm going to buy out here. 1, 2. And then I'm going to buy out here, buy a put. 1, 2. All right. And now I'm going to come in here and I'm going to make this one. Why is that saying 3 days? Oh, today's Friday. I'm going to make this one 3 days. And I'm going to make this one 3 days. And I don't know if that's the right thing to do or not. Very sensitive, not so sensitive. Protection against these. We're not going to lose hardly any premium on this one. We're going to receive a whole bunch on that one. So that's the wild eye side of this. We're changing up the theta. All right. And it goes back to what Bruce was talking about. Bruce was saying, are you sure we shouldn't be doing this on the weekend? I was like, actually, we should probably be doing this on the weekend. All right. So we're going to be, if I mark it into this, 5, it's going to take me to 525. Let's try it. Okay. So that's our strategy for today. And I want to run that and see what happens. 66% of the time, that thing's supposed to leave the 1 standard deviation. If it does, we'll make money on this little, it's a little strangle at this point. Well, actually, yeah, it's a little strangle. It's not a straddle. Straddle would be on top of each other, but they're right close to each other because they were near the money. So they're just a little bit in the money. But then we're going to collect this premium up here, 132 and 177 against our long calls and puts. And then we're going to get our insurance out here. This is going to be sensitive in case of a big move. We'll make money out here. This is, but I paid 242 for it and 330, but that's okay. Don't worry about it because it's going to not lose hardly any value because it's got to be good until Monday, close of Monday business. So they're going to hang on to a lot of value in those. So we're going to liquidate this at the end of the day. We won't lose much value there. Watch. This is the one I'm concerned about. Because if this thing market does not move outside that cone of probability, we're going to get our heinies handed to us, right? We'll collect the 132, 177 against our $1,000, but that's going to be I don't know if I like this strategy. We're going to try it. We're going to try it for the day. But I think what we better do is we better come in here and we better say we're going to liquidate this thing if it makes 25%. So we'll come in here and we'll say if it hits 25%, we'll take it off, which is $275. $275, and then we'll leave on our iron condor on the outside because that's what that is. That's an iron condor with a strangle. No, that's a strangle. The straddle. No, this is strangle. With a strangle on the inside. So we got a strangle insured by a condor. I don't know. Just trying. Just going to try it. I still like selling premium a lot better. We just got to perfect it. And what we got to do is now that we know that we're going to have 66% of the time the market leaves that cone of probability, and we've had such good success with it, we just got to come up with a better hedging strategy. And I've been working on that too. We could do a delta hedge, and I'll maybe teach you that one on Monday. I'll show you what a delta hedge is on Monday. That one you're not going to like. Bruce, you might like it. Bruce likes sausage. Well, this is definitely a sausage class because I don't know what the hell I'm doing half the time. I'm just testing stuff and learning. I'm learning along with you guys. I'm just one chapter ahead in the Sunday school manual. All right. All right, guys. That's it. I got a Sunday school lesson for you today. Let's come into our Sunday school lesson. Pull it up here. Give me a second. All right. I thought this would be a good Sunday school lesson, given the fact that we did some scalping today. All right. Plan your trade, trade your plan. Don't feed the piranhas. Become a piranha. All right. Don't feed the piranhas. Become a piranha. Retail traders are drawn to hot, low-cost breaking news markets like moths to a lamp. Professional traders or piranhas love to scalp these markets. They too seek out hot breaking news markets where they feed off of unskilled, and I put in there Robin Hood type traders. A lot of guys like to day trade on their little Robin Hood accounts with their cell phones and get their heinies handed to them every single time. Robin Hood is not good for that at all. Don't try and day trade on your Robin Hood account. That's silliness. All right. The piranhas are going to kill you. If you come to the table looking like that guy, that little orange guy on the screen, don't be that guy. That's the Robin Hood guy. All right. Best to avoid these markets until you have professional level trading platform and have mastered your trading skills. All right. So given the fact that we did some piranha trading today, I thought it'd be good to warn you guys against trying to do that type of trading if you don't have a professional level trading platform with the capabilities to give you that edge. You need the edge, guys, because there's other people out there who have that edge and they're going to chomp down on your little tail if you're not careful. All right. That's my Sunday school lesson for today. And we're going to let this little strategy run here and see if we can't collect a couple $100. I'll let you know how it goes. I'll take some screenshots of it. Oh, I have a screenshot I wanted to share with you. I was going to tell you yesterday, but I forgot. So this is what happened the day before yesterday. And so the market turned out And again, it was one where we sold premium. We collected $322. So it ended up being pretty good for us. That was a good trade. Again, another one of those sold premium option strategies that made $322. So that was added into our spreadsheet. And that's what happened to that option that we did a couple of days ago. All right. So that was that one. All right, guys. Guess that's it. That's all I have for you today. We will catch you tomorrow, and I'll take pictures of this and tell you how it turned out.